Hello friends, Namaskar. Welcome all of you to my channel. Today let's discuss about the analysis of the current and contingent liabilities. This is under the financial accounting context. Yeah, you can say that analysis of accounting information because it's very important to manage our short-term obligations because it will decide about overall our liquidity situation because we try to compare to what extent we have a current assets, yeah, current liabilities, and at the same time it's all about the contingent liability when you are dealing with the productions, but production of the product and let's see the attachment of the warranty, then in that case we have to estimate the product warranty, for example. That is simply the example of contingent liabilities. Now based on this background, let's move to the basically what we are going to discuss today. uh, I will be just discussing about is the context of today's discussion, that is the introduction part, is the liabilities and the like you trade credit account payable, that is also known as, yeah, bills payable, commercial draft, notes payable, yeah, that's a promissory notes, discounted notes, tax payable, yeah, other accrued liabilities, contingent liabilities. That's how we could estimate the warranty liability part and including its implication for overall analysis, friends. Now let's move to the what about the is its background. Simply, friends, the company needs both short term and the long term debt that you need to consider here sometime to meet our let's say the finance short term financing needs, basically to meet the customer demand. Then this is the current liabilities we are looking for, yeah, short term debt. And the sometime we also buy the goods or services on the credit, and that's about your trade creditors. There is no any return arrangement here. And at the same time we could also borrow the short term money through the banks also. For example, let's see that you have taken the 1 year bank loan, yeah, overdraft loan, and with the promise to pay the interest together with the principal amount at the end of the maturity period. That is the case. Now what about the is the liabilities, friends. Liabilities is all about, as you know that like your in accounting equation, if you remember, asset equals to liabilities plus equity. Here your business asset would be financed with the debt and equity. Now debt could be short term debt, which is the current liabilities, yeah, long term debt we say that. Now today's discussion would be overall is the current liabilities. In the coming days I will be discussing about it, about the long term debt analysis too. But remember, for the current liabilities which mature within a year is called short term debt, yeah, short term liabilities. For example, trade creditors, yeah, provision for taxation, bills payable, yeah, bank overdraft, on revenue, accrued expenses, dividend payable, like that. Now whatever the trade credit, we say that sometimes we buy the goods on credit, but we just provide the verbal promise to the seller that we would pay the dues figure on time. This is simply the case of trade credit, yeah, account payable, you can say that. Now the question is about how we find the cost of trade credit. The term is that you need to understand here, that is the credit term, that is 2 by 10 net 30. That means if the customer would pay within 10 days, would enjoy the 2% cash discount here. Okay. Now if the customer pay beyond the 10 days, will not enjoy any discount. Here the customer will receive this discount period when they pay within 10 days. That is the discount period is the 10 days, and seller provide this facility to induce the early payment. But remember, if you are unable to pay within 10 days, that will be the cost to the customer here. So we say that cost of trade credit arises from not taking advantage of the early payment first case. Under the discount condition is that we have to pay under the discount period, and effectively incurring an opportunity cost due to the missed discount. That will be the opportunity cost to the buyer as well. That this way you could analyze the result. And this equation you have to recall here, that is the discount percentage divided by 100 minus discount percentage into number of days in years divided by credit period minus discount period. Here credit period in this case we have a 30 days and discount period is 10 days, while discount cash discount percentage is the 2%. This way you could find the cost of trade credit. Okay. Now what about the bills payable? Yeah, next one is that promissory notes. Bills payable, yeah, you can say that commercial draft are the instrument drawn by the seller and accepted by the buyer for the payment on the expiry for the specified duration, but this is formal one where it simply indicate that for example, the banker to whom the amount is to be paid on the due date, and the goods will be delivered to the buyer against the acceptance of the bill. That is the case. While the promissory notes is we say that formal document where the buyer promised to pay the dues figure together with the interest. But remember, if you are unable to pay within the provided period, then here supplier could also charge additional interest too. Okay, that you need to note that, because your supplier, yeah, you can say that the banker would take the here credit risk. That's why they are charging the interest. Okay. Now, what about the discounted notes? Discounted note is simply, you can understand here, when we borrow money, then we just pay interest in advance. Then that is the case of discounted note, and which is also known as discounted on notes payable is sometimes referred to as a prepaid interest, which is classified as a current assets here. But remember, we don't have the is a practice is all about, we see that a practice which has a little theoretical justification. This is the practice PRACTIC. That's practice means we are talking about its implication in the real practice. We don't have any implication in the real practice, we can say that. Now, what about the discounted note accounting treatment? Then remember, if I would borrow money through this arrangement, let's see, I borrow 1 lakh money with the 10% interest. That means cash I would realize 90,000, 10,000 would be the interest here, and notes payable amount would be the 1 lakh here. But actually I received the cash today, that is the 90,000. But where here that's a loan provider, you can say that they could enjoy the 1 lakh value, and here borrower would be in the disadvantageous position. Now on the maturity date, you have to record this journal entry, like a note payable to cash one hand and interest expenses to discount on notes payable, like that. Even though it has a little theoretical justification, but when the question is about discounting notes accounting treatment, that this way you could do it. Now, what about the tax payable, friends? Like normally we pay the tax to the government in advance. Okay, just for example, let's say you pay the tax for your car, for your bike, for your scooty, like that, but we pay the advance tax. Okay, but actually tax means when we tax are the expenses for the business, remember, and should be accrued in the same manner as any other business expenses. Like income tax, we say that in income statement, we say that income tax paid as expenses. But remember, in which income is earned, that is the point you need to understand here. But liabilities should be estimated or recorded by an adjusting entry at the end of the period. For example, let's see, I'm talking about how we record the journal entry for tax that has not been incurred. You paid, but it is unpaid, we say that is the tax to be paid. Then in that case, we say that income tax expenses to income tax payable account. This framework that you need to understand here, for even the sales tax, we say that cash account journal entry to record the sales, collection of the sales tax. If you have a restaurant, let's see, cash account debit, sales tax, sales account debit to sales tax payable account. For example, this is the VAT 13%, like that. Now, journal entry to record the payment of the sales tax. Now, the sales tax payable to cash account. Okay, that is this way you could record the journal entry. Now, even for the other accrued expenses like your salary payable, we say that salary expenses to salary payable account. Then similarly, there might be the case of other expenses too. When you have accrued expenses, simply you have to format this one, interest accrued, interest expenses to accrued interest payable account, like that. Okay, now let's move to the dividend payable. Like a dividend, let's say that this is a portion of the profit to be distributed to the shareholders, and the board of directors proposed a certain rate of dividend to the shareholders, but that must be approved in the annual general meeting. Now, this is called the proposed dividend case. Now, it has not been paid, so this is the dividend payable. Now, what would be your journal entry? Based on accrual accounting system, let's say the dividend expenses account debit to proposed dividend, or you can say the dividend payable account, friends. Now let's move to the what about the contingent liability. Even I discussed in my last video related to concept of contingent liability, including the estimation of the product warranty. Then let's discuss in summary way that is the contingent liability. Simply we say that is the An obligation that involves existing condition for which outcome is not known with the certainty. We don't know. That's a probable liability, we can say that, which depends on the some event that will occur in future. That is the probable case. Okay. So one of the example is the we see that the contingent liability is the product warranty or the guarantee, and contingent liability should be reported in the financial statements, and if they are probable, we say that, and the amount of liability can be reasonably estimated. So estimation of the product warranty is important. Now contingent liability, as you know that when the as a seller, yeah, when a company provide the like your warranty, for example, let's see the flip product, we say that is the flip light company, yeah, we see that Baltra brand fan, you purchase it, and with the attached warranty is there. That means it could provide the assurance to the customer, and through the product warranty, that is a contingent guarantee of the parts like that. But servicing warranty involves the additional cost. Even I discussed the same thing in last video. Okay. And then as a your company, you have to at least understand how many like your claims did you receive over the period from the customer, their impact, and what would be the eventual cost associated with the product warranty given to the customers. So we there is a need of your proper accounting treatment for estimation of the product warranty, and that is why let's see the in this example I already here discussed in this video, like my YouTube channel, you could find it. That is the video number 333. That is, we have a sales of 1000 while its selling price is 800 with the 3 years comprehensive warranty, which cover up both parts and labor, and no claims are made by the customer in the year one, but the similar branded product in the past have resulted in the similar, but 4% you came to know that of the sales would be defective, and average is that's 80. So we say that is the 4% of this value into this would be, that is the 3200 is my estimated product warranty. Okay, this way you could estimate it, you could record the journal entry like that, and then even we prepare the T account like that. I already discussed all these things, that's why I'm not going to discuss the same question time and again. So for this you can take the reference of the created content, that is the video number 333, friends. Okay friends, these are the things that I would like to share today. If you really like this content, please like, subscribe, and also share my channel. Thank you all of you for watching this video. Please take care all of you. Thank you.